Hello friends, this is our 13th video lecture and it will be about IAS 38 Intangible Assets. Definition of intangible assets. IAS 38 defines intangible assets as identifiable non-monetary assets without physical substance. Intangible assets must meet the basic definition of assets. Intangible assets must be controlled. Future economic benefits must be expected. What is control? Control is the result of possessing a legal or contractual right over the resource. Common examples of intangible assets are copyrights and patents. So, employees and training provided to the employees cannot be classified as intangible assets due to lack of control. Absence of physical substance. Intangible assets do not possess any physical form. They cannot be detected with our senses. Non-monetary item. Intangible assets are non-monetary items. Monetary items, for example accounts receivables, cannot be classified as intangible assets under IAS 38. Identifiability. Intangible assets must be identifiable. An asset is identifiable when it is capable of being separated or divided from the reporting entity and sold, transferred, licensed, rented, or exchanged. It arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity. Sorry for this mistake here. So let's move further. Combination with tangible assets. Intangible assets are often combined with tangible assets. For example, computer software may be stored on a disk or a computer. Intangible assets IAS 38 Intangible Assets provides guidance about the treatment of such assets. If the software is an integral part of the hardware, it should be accounted for under IAS 16, for example, software provided with printer. If the hardware can operate without software, the software should be treated as a separate intangible asset and accounted for under IAS 38. If the value of hardware is insignificant and secondary, the whole package should be treated as an intangible asset and accounted for under IAS 38. Initial recognition. Intangible assets should be measured at cost on initial recognition. Possible acquisition scenarios of intangible assets are separate acquisition, acquisition by way of government grant, exchange for another asset, acquisitions as part of business combination, internal generation. Initial recognition. Intangible assets can be recognized in the statement of financial position only if it is an identifiable non-monetary asset without physical substance. It is probable that expected future economic benefits that are attributable to the asset will flow to the entity. The cost of the asset can be measured reliably. So, acquisition of intangible assets. First scenario, separate acquisition. Key assumptions under IAS 38 in respect of separate acquisitions. The price paid to acquire an intangible asset usually reflects expectations about the probability that future economic benefits will flow to the entity. The cost of a separately acquired intangible assets can be measured reliably. If both of the recognition criteria are met, then such items must be recognized in the statement of financial position. The cost of separately acquired intangible assets consists of the purchase price, including non-recoverable taxes, all directly attributable costs of preparing the asset for its intended use. Important: capitalization of expenses must be stopped when the asset is in the condition necessary for it to be capable of operating in the manner intended by management. So when the asset is ready for use, we must stop capitalization of expenses. So let's discuss what should we capitalize and what we shouldn't. Costs which shouldn't be capitalized include the costs of introducing a new product or service, including costs of advertising and promotional activities, the costs of conducting business in a new location or with a new class of customer, including staff training costs, administration and other general overhead costs, costs incurred in using or redeploying an intangible assets, costs incurred while an asset is already capable of operating in the manner intended by management but hasn't yet been brought into use, and initial operating losses. All these are examples of costs which shouldn't be capitalized. Acquisition by way of government grant or exchange. This area is covered by IAS 20, in accordance with which, in respect of government grant, intangible assets received by way of a government grant may initially be recognized either at fair value or a nominal amount, being the amount paid for the allocated resource. This approach should be applied consistently. Intangible assets obtained in exchange for another asset must be measured at the fair value. Acquisition as a part of business combination. In the case of business combination, there is no such thing as cost for each individual item being acquired, because there is one overall price which is paid for target company as a whole. In accordance with IAS 38, the cost of intangible assets acquired in a business is the asset's fair value. Recognition criteria. In this case, the criteria concerning the probability of future economic benefits is always deemed to be satisfied. Also, IFRS 3 states that the cost of an intangible asset acquired in a business combination can always be measured reliably. So, sorry for this mistake here. Concerning IFRS number 3, we are going to look through it in a separate video lecture. So let's move further. Internally generated intangible assets. Internally generated intangible assets are usually not recognized. Such assets would not qualify for recognition on the grounds that their cost cannot be measured reliably. And examples of internally generated intangible assets: customer-related assets, for example, customer contracts; internally generated trademarks. Intangible assets can only be recognized when it is probable that future economic benefits will flow to the entity, the cost of the asset can be measured reliably. Internally generated assets do not always bring future economic benefits, and it is often impossible to reliably measure the cost of internally generated intangible assets. IAS 38 deals with this challenge. It classifies activities into research and development phases. So, research phase. IAS 38 defines research as the original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. For example, studies conducted in order to find a cure for certain disease can be classified as research. Sorry for small mistake here. Research is a preliminary activity. Therefore, future economic benefits from a project cannot be ascertained at this stage. Hence, all research costs should be charged to profit or loss account. Development phase. Development is defined as the application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, devices, products, processes, systems or services before the start of commercial production or use. For example, if a company discovers cure for certain disease and is going to develop commercial product, then the subsequent phase can be classified as development. Development expenditure must be classified as an intangible asset if an entity can demonstrate technical feasibility to complete the asset, intention to complete and use or sell the asset, ability to use or sell the asset, existence of market for the output or usefulness of the asset, availability of all resources to complete the asset, reliable measurement of cost of the asset. If any of the criteria are not met, the asset must be charged to income statement. Additionally, if an entity is unable to distinguish between research phase and development phase, it must treat all expenditure as if it is incurred during the research phase. Directly attributable costs. According to IAS 38, cost of internally generated intangible assets should include directly attributable costs necessary to create and prepare the asset for its intended use. Some examples of this are costs of materials and services, costs of employee benefits, fees for legal rights, amortization of licenses used to generate the intangible assets. The following costs must never be included in the value of intangible assets never be included. So, indirect costs, general overheads, initial operating losses, staff training costs. Specific internally generated intangible assets. IGIA refers to internally generated intangible assets. IAS 38 specifically prohibits the recognition of certain internally generated intangible assets. These include goodwill, brands, mastheads, publishing titles, customer lists. Measurement after initial recognition. IAS 38 prescribes two possible measurement methods for intangible assets: cost model, revaluation model. IAS 38 allows to choose any one of these two methods. A consistent approach must be followed for a specific class of assets. Cost model. Under the cost model, the carrying amount of an intangible asset is equal to its cost less accumulated amortization and accumulated impairment losses. Intangible assets are amortized. Amortization is the systematic allocation of an asset's value over its useful life. An entity needs to define next points for amortization: useful life of the asset, amortization method, residual value of the asset. Useful life. Useful life of an intangible asset can either be finite or indefinite. No amortization is charged for assets having indefinite useful life. However, these assets are subject to compulsory annual impairment tests. The decision to classify the useful life of an asset as indefinite must be reviewed at the end of each reporting period. If this classification is no longer justified, the asset's useful life should be classified as finite. Amortization method. The amortization method should reflect the pattern in which benefits associated with the asset are expected to flow to the entity. Common amortization methods include the straight line method, the reducing balance method, and the sum of digits method. Residual value. IAS 38 defines residual value as the estimated amount the company would currently obtain from disposal of the asset after deducting the estimated costs of disposal. Due to the absence of proper markets for sale of certain intangible assets, the residual value is often taken as zero. So, as you can see, this is quite related and a lot of similar with IAS 16, property, plant and equipment. We actually also have reviewed straight line method, reducing balance method, and the sum of digits method. As you can see, amortization is very similar to depreciation, but amortization is the systematic allocation for intangible assets, and depreciation is the systematic allocation of an asset's value over its useful life for property, plant and equipment items. So as you can see, it is really a lot of similar between IAS 38 and IAS 16 in this area. So let's look through a simple example Our entity Fluffy Kitten has started to invest in a new drug as at 1st February 2017. Expenses per month invested in new drug are $50,000 per month. On 1st September 2017, Fluffy Kitten has demonstrated the commercial viability of a new drug and intend to sell it on the open market. Expenses starting from 1st September are still $50,000 per month. As at 31st December, the drug wasn't complete yet, but it is expected that it will be completed in the second quarter of 2018. Please explain the treatment of costs in financial statements as at 31st December 2017. So, let's try to solve this task. Research stage started on 1st February 2017 and ended on 31st August 2017. As you can see here, we know that investment started on 1st February in new drug, and on 1st September Fluffy Kitten has demonstrated the commercial viability of a new drug. So that is why the research stage is from 1st February 2017 till 31st August 2017. Starting from 1st September 2017, it is a development phase. So research expenses will be 7 months period from 1st February till 31st August. That's actually 7 months. So 7 times 50,000 equals $350,000. And this expenses must be disclosed in statement of profit or loss. Development stage started on 1st September 2017, and development expenses must be capitalized. Development expenses as at 31st December 2017 will be, that's actually a 4 months period, so 4 months times 50,000, and it gives us $200,000, and this must be disclosed in statement of financial position. These expenses must be capitalized. As at 31st December 2017, the drug wasn't completed, hence no amortization should be charged. So, that is the end of our lecture number 13. I hope it was useful. Thank you very much for watching. Bye!